Retail inflation has crossed the Monetary Policy Committee's tolerance level that would, in a normal situation, imply that the six-member committee will hike rates in the next meeting. But India's GDP is slotted to grow at its slowest pace in a decade, and a rate hike would only complicate matters. So, are we really staring at what's defined as stagflation, or is this a sharp spike in retail inflation a temporary phenomenon? We'll pose all of these questions to Siddhartha Sanyal, Chief Economist and Head of Research at Bandhan Bank, who's joining us right now from Kolkata. Siddhartha, thanks very much for taking out the time. This definitely has made heads turn with regards to the kind of CPI number that got posted yesterday, 7.35%. We've seen this in 2014. We're seeing this again. What was your reading out of this number that came out, and is this temporary in nature according to you?
Yes, this has been a big surprise. We were expecting this number to be at a pretty high level, but even we were expecting it at around 6.9%. So compared to that, the 7.35 is a significant upside surprise. But the good thing here is it's not necessarily driven by the core inflation or the more sticky part of the inflation basket. It's being driven by some of the more volatile components, which often go up pretty fast and can correct also relatively quickly. So if you see the dynamics of current inflation spike, of the 7.4 odd percent inflation print, almost half of that is coming only from the vegetable basket. So if that normalizes over the course of the next few months, and which remains a clear possibility, then the numbers will start looking a lot better. But no doubt about that at this moment it has come as an ugly surprise.
Right. So, Siddhartha, there is some chatter that while obviously vegetables and fruits, the seasonality factor kicks in, but the concern more remains on the protein basket and the pulses prices, which could actually extend themselves a little bit further. In light of that, do you believe that the CPI inflation numbers, even if vegetable and fruits do come off, could continue to remain elevated on the back of pulses and other proteins?
Well, I would still continue to put the blame more on the more volatile perishable items like vegetables, because if you actually do the maths in terms of weighted contribution, out of the 7.4, 3.7, as I mentioned just now, coming just out of vegetables, and if onion prices actually do soften to their usual self, which you get to see in the winter months, that itself can provide a buffer of close to 2 percentage points to this particular number. So overall, if and when you get to see the softening on that particular front, even if there is a bit of pressure on pulses and protein prices in general, the numbers would start looking a lot better. And do not forget that at this moment, the core inflation numbers, the numbers which actually show some kind of strength of demand in the economy, are still very weak. And as you also rightly pointed out, given the momentum in the overall economic activity is relatively poor, and consumer sentiment and business sentiment indicators are not really that strong, it's very unlikely that the inflation pressure will really be generalized.
Let's talk about the impact of the increase in telecom tariff rates, and have you seen them play out completely, or are we still awaiting that when we see the next month inflation numbers?
It's not ruled out. Maybe some of it might get captured subsequently as well. But as of now, what we get to see, there are interesting small contributions from some of these segments. For example, telecom tariffs are contributing something close to 20 odd basis points in the current inflation print. The other thing we are not discussing, we haven't really discussed, that is gold prices. Gold prices are contributing also close to another 20 odd basis points in this particular inflation print. So there are a lot of other areas which are contributing apart from vegetables, but at the same time I'll not call it generalized inflation given the broader industrial price pressure is still very weak.
While crude has been slightly more volatile, it's come back down from those heady levels of about 70, 72. Do you still see as crude also posing a risk?
Well, yes, especially given the current scenario in the Middle East, where there has been renewed geopolitical tension, you have to remain watchful about crude. But at the same time, the good thing about that, when we are talking about the CPI basket, that even despite in the coming months, even there is a possibility of crude prices or domestic petroleum product prices going higher, I would still assign a possibility of some of the other variables which had spiked too much of late might actually come down and provide some bit of buffer. So just to summarize things in terms of our expectation, in terms of what we might get to see on the inflation front, it's we might have to remain cautious over the course of the next 2-3 months. But at the same time, once the winter crops hit the markets, and the possibility at that point of time, the possibility of winter crop prices coming down significantly is not really ruled out. So at the time of the early summer months, I possibly would expect the inflation numbers to be significantly softer than what they stand as of now. So as such, while they are posing some bit of surprise, some bit of question mark about the trajectory as of now, 3 months down the line, 4 months down the line, the scenario can be very significantly different.
All right. Then 2 questions wrapped into one, Siddhartha, since I'm completely running out of time. What do you think the RBI stance on this could be, and does it have enough wiggle room? And the other part of my question is, now with the budget around the corner, growth is the focal point. It's almost sort of addressing a growth emergency. You'll need creative solutions to this. Do you on your own have any ideas on what the government could do in order to make sure that it could, in a way, bring back growth on track?
Sure. So in terms of the RBI's policy, I think it's relatively straightforward as of now. Even though there has been a very sharp jump in the headline inflation prints over the course of the last 2-3 months, especially in this particular print, taking the overall dynamics into account of growth and inflation, and given that we very clearly expect this inflation spike to be very temporary in nature, we don't expect the RBI to change their accommodative stance. They're not in a position to cut the rates at this point of time, but there is absolutely no question of them hiking or thinking of hiking the rates at any point of time. So very clearly a status quo in this particular policy with an accommodative stance, and it's possibly a 6-0 vote in favor of this particular outcome in this particular policy. So in a way, this particular policy is possibly relatively more predictable. The question is when there can be, and our sense is that in FY21, that is the financial year that will start in another 3 months' time, our sense is that there will be space for further monetary policy easing as and when the inflation prints start coming down, because growth momentum doesn't look strong. When the temporary pressure points on inflation start softening, very clearly the focus will go back to that particular aspect, that they need to support the economy more. And if you see some of the comments from the monetary policy and from Governor Das, they're very clearly highlighting that there is a need to support this particular, at this juncture, there is a need to support the economy as long as growth momentum remains that weak. So our sense is that there will be space for RBI and MPC to offer more support in FY21, but obviously at this point of time, they have to stay on hold.